to Sean Canham from mate, one of my trusted right-hand men within SWB. Thanks for joining us, mate.
Yeah, no worries at all, mate.
Mate, what I'd love to be able to go through is talk to some of the people that are listening, also online, and some of the videos that people will see over Christmas. With the diversity of our business, and we've seen, you and I, a lot more inquiry when it comes to commercial lending, business lending, and the SMSF business and residential at the same time. I wouldn't mind talking a little bit about commercial and, like what you're seeing in the market. Why should people look at using us as a brokerage as opposed to other avenues? But what are the probably most talking points for when someone is considering a commercial loan? How does a bank view these people? How does a bank view an application? Because it's completely different to a home loan.
Yeah, so look, I'll start. There's a few questions in there, but I'll start with why you'd use a mortgage broker rather than going direct to a bank. And look, I don't know the exact numbers, but something like 30 to 40% of commercial and business lending is written through brokers, which means 60 to 70 go direct through their existing bank. And that's kind of flipped on its head from what you see in the residential and consumer market. And it's typically because our clients have less confidence when it goes to business lending and commercial property purchasing. So they usually go back to the bank that has all of their business transactions, and that's completely understandable. So the gap that the mortgage brokers provide is just very similar to residential lending for a mortgage broker. We cover that gap between the client's current financial position and their business performance and their goals and what they hope to achieve, and then we find a suitable bank. Because similar to consumer lending, the best bank for the client may not be the one that they are currently banking with. So
you've got a client out there, an existing client or a new client looking for a commercial loan. What are you, people talk about the famous 5 C's, right? And when you break that down for people that are listening, what are the 5 C's?
Yep, sure. So 5 C's are credit, character, capacity, capital, collateral, and conditions. So the character, you can think of that about who are you and what are you trying to achieve. So oftentimes this is the most important part of our assessment, because once you have a look over somebody's company financials, the numbers are the numbers. I'll do my analysis, the bank will do their analysis, and we typically come to the exact same point. So the numbers tell a story, but not the whole story. The character is typically the main piece that we need to cover off, and that's the management of the company, the management of the business, and also the forward projections. So do you have a business plan? Have you projected your cash flow over the next 2, 4, 5 years? But also that, and what does the historical performance look like around your management? So not necessarily the numbers, but what have you done? How are you growing the business? Yeah, essentially, who are you and who's the business? Because we see a lot of clients who are looking to do something commercially, maybe purchase a commercial property, but maybe they're not the day-to-day operators of their business anymore because they've hired a managing director or so on and so forth. So we need to get a really good understanding of the company and of the business and how it's managed and how it's performing. The next one is the capacity. So that's just the purchasing entity's ability to repay the loan that it's applying for. So in commercial, it can get a little bit more complicated because a lot of people establish what's called a special purpose vehicle or an SPV. So that SPV purchased the property and it's kind of done so to silo that asset, silo that income. So the banks don't have recourse over absolutely everything within the family's entire entity structure.
So what you're talking about there is if you've got mum and dad or whoever it may be, if they've got personal assets, if they're looking at doing a commercial loan, structuring it in a way where it doesn't have that connecting kind of ability to their own property is what you're saying.
Yeah, that's right. So there's always things called directors' guarantees that link those individuals to the debt. However, it's not a straight line. It's not as straightforward. The banks deal in risk, right? I tell all of my clients the bank's primary operation is dealing in risk. They assess your risk and your ability to repay the loan. The outcome of that is debt or cash. So the more risky you are, the more expensive the loan's going to be. So a lot of banks will ask for directors' guarantees just to mitigate a lot of that risk, bring down your interest rates, and make it a lot easier to get the loan approved.
And the next one, mate?
Capital. So that is the statement of position. So what assets do you have? What assets does the company have? And what are the liabilities against all of that? What's your net asset position, essentially? If you had to sell down everything, what do you look like?
Yeah.
Which is pretty unique in the commercial space, because you can look at things like vehicles within the company, equipment that you need. So, yeah.
From a commercial aspect, is that you're seeing, like we've financed two employees looking to invest into a company that was up on the market they were working for. Mm-hmm. That was a commercial loan, mm-hmm. and that worked because obviously they were in the game, and it makes it look a little bit easier. Yeah. And recently we've had two inquiries. Young couple wants to buy a business which they've never been involved in before, i.e. a gym. I was not recommending that they did that, but anyway. Mm-hmm. And then we had another guy who we've got as a client looking at purchasing a commercial property in New South Wales. Yeah, not in the same field whatsoever. Yeah, it's funny how the banks kind of look at that. Not saying that they can't do it, but they just make them go through that extra yard because they need to justify, yes, they know what they're doing.
Yeah, that's right. And that goes back to the character piece. Yeah. So the first clients you touched on there, they were managing directors and primary shareholders of the company that they ran on a day-to-day basis. And they were buying out the previous non-operating shareholders. So they had an intimate understanding of how the business operated, how the business worked. So that got approved quite easily. Whereas the other ones, there were change of industry, there was little known information about the ongoing performance of the company. You can write a business plan as much as you would like, but if you don't have the history behind that, then it is difficult for a bank to trust and rely.
You know, in the last probably, I don't know, it must be the age between the 40 years of age and 50, people that have been typically working as PAYG for the majority of that time have this. And I experienced that as a kid. My father was an electrician. He went and purchased a Mexican restaurant, mate, So from pliers to nachos, effectively, right? And he didn't know anything whatsoever. Didn't have the business acronym in terms of what's what. And I see that a lot, Shawnee. I see that a lot. People have gone, hey, I'm over this. Yeah. I want to try this. And, maybe because of my childhood experience of seeing that it, typically didn't work. I don't think people quite understand the concept of going, hey, you're about to step out of a job or something that you've known for so long. The bank's about to lend you the money. You have to go through all these protocols. Yeah. And outside our lending rules of the 5 Cs, you've still got to sit with an accountant, which you would recommend, to do a business plan, to do cash flow analysis. So you're easily investing maybe $4 to $5 grand just in that. Yeah. So would you recommend for any of the listeners out there or people watching, if you, Sean, were looking at going and buying a business, you're a finance broker, but you were looking at buying something that was typically outside your realm, what would you do?
I'd lean on the experts around me. So I'd engage my solicitor and I'd engage my accountant as the two primaries. Obviously, as a mortgage broker, I know a little bit about it, but I'd also engage my finance professionals as well. So you have to make sure that the experts that you employ have a clear understanding of what your goals are as well, and to ensure that what you're buying is going to be profitable when you enter it. If you're purchasing a business and you're buying it off a managing director, is he the key person? And are they going to exit the business immediately? And if they do, what happens to that company? There's a thing called goodwill. Does all of that goodwill exit when that person selling the business leave as well? So there's a lot to do, but the primary thing you got to do is get all of your financial experts around you.
And this probably would put a lot of people off, right? So they like the concept. But obviously you would do your due diligence prior. So we've covered character, capital. Let's talk about collateral and conditions.
Yeah. So collateral is the security that you're offering the lender for the debt that you're getting. So typically what you see is, or the easiest way to explain it is, you're purchasing a commercial property, a warehouse, an office, a retail space, whatever it may be, and you're offering that property as the security. So when we do our collateral analysis, we look at the asset type, we send a valuer out, as well as your contractor when you purchase it, and they assess the property and give us a market value. Now, depending on the type of property and the size of property will depend on the type of valuation that's needed. It's not like a residential home where the valuer goes, excuse me, where the valuer goes out and assesses the property, looks at the surrounding suburbs and areas around you, look at recent sales, and then give you a value on your home. What they do with the commercial property, if there's an established lease, so basically a tenant, they will assess that lease as well, and that lease can go into the value of the property. So if you think about it on a big scale, if you're looking to buy a shopping centre and one of the shops is leased by Woolworths or Coles for the next 10 years with a 10-year option at the end of that, that asset's going to be worth a whole lot more than if there was no supermarket, right?
Yeah.
So therefore, you're buying the lease as well as the property. So that can increase the value. And one of the things that I always tell my clients, if they're looking to purchase commercial property as an investment, meaning they're not moving their business into it, is to have a look at the lease, have a look at the lease conditions, have a look at the lease term as well. Because if it's only got 6 months to run with no option, then you're probably going to have to talk to the real estate agent about getting that current tenant to extend or get a commitment from them to extend.
Which brings us to the next part you just spoke about, conditions. Because they can vary, right?
Yes.
So what typically do you see the conditions go with someone that's looking at buying what you just mentioned there, someone that's just buying something brand new, have never done it before?
Yeah, well, the conditions is the last piece, because this is basically what the bank puts on you as the borrower. And it involves all the previous four that we've just touched on. So if the bank thinks that, for example, the security you've offered doesn't have a long lease, if it's only got 3 years left to run, the bank will only give you a 3-year loan term. Now, they'll make it interest only for those 3 years. They're not going to ask you to pay it off in 3 years. It'll be interest only. But they'll only give you that term. So at the end of the 3 years, you do another review. So we call you a couple of months before the end of the term. We do a review of the lease. We do a review of your financials, and we extend it back out again. So it's really heavily dependent on the type of asset you buy, the type of lease that's in place, the type of income that you have, and all of those types of things. So
it can be quite volatile, do you find? Or,
yeah,
because that's what, commercial is obviously a lot more scrutinised than residential, right? Because
I don't know about volatile. It's just case by case. It's really the loans are often shaped according to the borrower, whereas in resi, you get a 30-year loan term, right? And the bank gives you 30 years to pay it off. Whereas in commercial, you're usually looking at 10, 15, 20, 25, and sometimes 30-year terms. It all depends.
And I suppose the positives for people out there listening, I mean, I know that we use the podcast Boss, where we're recording at the moment, and, we're looking at financing something for him so he can work out of it. So he's essentially not having to pay rent anymore. It's his own premises.
Yeah.
That makes sense, right?
Yeah, 100%. So whenever we look over financials for self-employed individuals who are looking to do, maybe it's just their home or they're looking to do something within their personal name, we always look over their financial statements and balance sheet as well. If they've got a lease payment going out, meaning you're running your business, you're paying a lease to somebody else, then it's always worthwhile having a conversation around, can you afford to buy your own premises? Is it worthwhile buying your own premises? And then once you ascertain, yes, it is a goal that the client would like to achieve, then you look at, okay, well, what entity do we house this in? Do we set up a special purpose vehicle? Do we do it in the trading entity, which is typically not recommended? Or do we do it in a self-managed super fund, which is another option for people as well?
So outside the mainstream banks, we've got avenues for people as well that we have access to. So for anyone out there looking to venture into this world, your top 3 things that you would recommend that they do right from the beginning. Number 1 would be what, mate?
Have a goal. So establish a goal that you want to achieve yourself. It's very difficult. We've all had clients who come to us and they don't exactly know what they want to achieve. It's very hard to give them advice that's personalized to them when they don't entirely know what they want to achieve. And that can be a pie in the sky. It can be a really outlandish goal that you want to achieve. And if that is, that's okay. We can help you lay a pathway to get to that goal. Or we can be realistic and tell you what's possible. But without a goal, it's difficult for us to help you.
And the second one?
Second one is in regards to finding the property. So if we're looking at commercial lending or even residential lending, to be perfectly honest, they're both the same, right? It's location, location, location. So, and with commercial property, that doesn't necessarily mean close to the CBD. It may mean if you are looking at purchasing an industrial site, access to highways, access to freeways, things like that.
The amenities, yep.
Yeah, that's right. If you're looking at an office space, because like us, we're financial brokers, our clients come and visit us quite a lot, access to car parks, things like that. So you've got to look at the asset. You've got to really nail down, is it in the right location and has it got the right purpose?
Plus also as well, I think one thing that we've got to mention there is that if you're, we're purchasing something, just say for hypothetical, we go and purchase a property for the business. We've got to make sure that, if we decide to keep it, to rent it out, someone else can look at renting it, right? So it's not just for our purposes. I think a lot of people maybe have that not in mind.
Yeah, definitely. So with commercial, you've got specialised properties. Think of things like a service station or a childcare centre or a pub or a club, a hotel. Very difficult to repurpose that into something else. So therefore the banks look at it. Remember I mentioned banks assess risk. One of the risks that they look at is the ability to sell that property if you go bust. Yeah. So if it's a specialised property like a service station, it's very difficult for them to find another buyer for that service station outside of someone who wants a service station. Whereas if it's office space or retail space and some industrial, it's easier for them to find a buyer to buy it off them. So that mitigates the risk of the asset.
And the third?
The third, I would recommend link up with your financial experts. So it's something that I've touched on previously here talking about, but that's your accountant, your financial planner, your mortgage broker, and your solicitors.
Do you know, it's funny, it brings me to, people will say to us, in a home loan part, we've been brokers for a long time, right? People will talk to us about, hey, what's the interest rate? You and I both know commercial is viewed upon risk.
Yeah, that's right.
Which then predetermines what the interest rate is. So it's hard to give that to people, right?
Yeah, it's very difficult. So on a consumer side of things, we've all heard of the standard variable rate. So typically with a consumer, you get your standard variable rate. If you've got a really big deposit, you'll get a discount off that standard variable rate, and that will be your interest rate. With commercial and business lending, the banks start with a base rate, and that's a pretty low interest rate. And then as they assess your risk, so all of the 5 C's I've mentioned, but also the industry that you're in, they allocate other things called risk margins and things like that on top, line fees for certain products. So your rate actually can creep up. The more risky you are, the more risky the industry, or the more risky the asset. Yeah. So it's all about risk.
It is, mate. It certainly is, right? But it's exciting at the same time, that we've financed a few businesses.
Yeah. And
it's exciting because, they've eventually broke that mold and they've purchased something that they've either been working in or something that's brand spanking new.
Yeah.
So I definitely see the appeal. I just hope that patience is the key, obviously, with commercial as well, right?
It can, because of the complexity and the more rigorous assessment that needs to take place, it does take a little bit longer to get an approval. Yeah. There's a lot more hurdles you have to jump through with commercial, just because of the extra risk associated with those types of borrowings.
Yeah. So. Mate, business lending, right? Just we'll talk about that quickly as well. Business lending, not commercial lending, business lending. We've obviously helped a few businesses this year, because people can kind of get them quite confused, right?
Yeah.
Do you find that as well?
Yeah, definitthink. So
how would you distinguish between them both?
Well, I suppose if you're purchasing a commercial property, the way I just think about it is commercial property loan. Business lending is typically borrowing to help your business grow
Yeah.
in other areas other than an asset.
Yep.
So a lot of people might call it cash flow lending, invoice financing, trade finance, all those types of things. Basically debt that you need to help your business grow its income streams
So
typically.
it's typically more for existing people that have got businesses, right?
Yeah, that's right. Very difficult to get like an unsecured cash flow lend if you're just starting out. And that's one of the main things that people inquire of us. Like you touched on it before, a lot of people, they hit that 40 to 50 mark. They've been doing their career for 20 years. They've got good equity behind them in their home. So they're looking to do something different. And they're looking for a cash injection into that company at the start, which can be quite difficult to apply for.
I'll give you a quick scenario. I'll give you a quick example. A mate of mine went and purchased. He was went and purchased a pool business, and he was not in the same industry, completely different industry. And we had approached a few of the banks, as we know, but then went down an avenue that was a non-traditional bank. After analysing what the proposal that they gave him, the business loan, and took over his home loan, there's some substantial pressure on him now to do a certain amount of pools every month.
Yeah.
As opposed to starting a business yourself, not having that pressure. And that's where I think people get mixed up. It's like, I've seen this business, the business works, this is what it's bringing in, however, I need to finance it. And that's where the pressure can come.
Yeah, that's right. And a lot of people look to purchase a business, and whoever's selling the business obviously wants money for it. So the person buying it does it with debt. And so if you look over a company financials, a profit and loss statement, tax return, whatever it is, and the company is profitable, but then you throw a big lump of debt at it because you have to get debt to buy that business. You have to make sure that that business can handle the debt that it's taking to essentially buy itself.
100%, yeah.
And then you also have to remember you've got a family, oftentimes you've got a mortgage as well, car loan that you have to maintain outside of that business. So,
but you also become
tricky.
the bookkeeper, you become the accountant, you become the marketer.
Yeah.
Do you know what I mean? So there's many hats that you got to wear. So business lending, Shawnee, just super quick. If you've got an existing business that's going well, you're looking at scaling up.
Yep.
Now, scaling up would be putting on more staff or, just maybe doing other things that that would increase the capacity of the business. What are some things that a bank looks at for that?
It goes back to that character piece. If you are borrowing against the business to grow the business, the bank will want to know, well, what are you doing? What are you going to use this money for? How's it going to work? What's your projections? What's your projections to repay it? Things like that. So we had a client who was looking to get some debt out to grow his business in other areas, to acquire more businesses as well. And the main thing the bank came back for was, okay, I want your 4-year cash flow projection.
Yeah.
And then the 4-year cash flow projection came back and it was relatively good, but they hadn't made a provision for increased taxes for the company, increased PAYG taxes and superannuation for the employees.
So the deal didn't go through.
So the bank came back with a lot more questions around, hey, what are we doing with the tax position? You're showing cash flow growth, you're showing profitability, but you haven't got an allocation for your tax here. We need to make sure that there's an allocation for tax based on the increased profit, there's increased tax. So once they did that, the deal started to look really skinny and it didn't proceed.
So for any of the listeners out there with existing businesses, suggestion would be sit with your accountant and make sure that you can manage, your commitments, number one. ATO debt, we see a lot of ATO debt, and this is probably something I just want to talk about before we move on to the next topic. We see a bucket load of ATO debt out there for businesses. COVID, we're still feeling the effect with small businesses, right?
Yep.
Interest rates have gone up in many areas, personally and business. We can accommodate that. There's businesses I'm seeing more so now that for business loans, we can pay out ATO debt. And, the banks can obviously look at lending. My question is that if you've got an ATO debt, you're not dead in the water.
No, definitely not. Well, when you've got an ATO liability, you've got a few different options. You can enter into a repayment plan with the ATO,
which is roughly what, 15%?
Oh,
11%?
No idea.
I think it's roughly about
No
that.
idea. So you can enter into a repayment plan with the ATO. And if you have a repayment plan with the ATO and you go to a lender and you're trying to get debt for other purposes, that ATO debt under liability is completely fine as long as you're meeting repayments and making them on time. We just have to include it as an ongoing liability. Not every bank will allow that, but a lot will. And then some banks will give you a loan to clear and close that ATO liability. Again, not every single bank wants to clear ATO debt, but more and more are coming on board to do so. So 5 years ago, you wouldn't have found any of the majors paying out ATO debt. Now, a lot more are putting up their hands saying, we will pay out ATO debt as long as it's a really solid deal in all the other areas.
Would you find that they'd take a GSA or security over the business or security over a property?
Yeah, at times for sure.
If they're doing that?
Yeah, definitely, because obviously you take extra security, you're taking extra collateral, so that brings the risk grading down, which makes the client a lot more appealing to a lender.
So if anyone that's out there listening that owns a small business, it's not the end of the world. Just come and speak to us. We can help you look at paying out some of the ATO debt, get you back on your feet. But also at the same time, even if it's to pay out ATO debt and you've got expansion for the business, there's many avenues that we can look at, your traditional lenders and what we call your second tier lenders. Shawnee, just before we wrap up, SMSF, I mean, you and I do them quite a bit within the business. I would say maybe on average, maybe 2 to 3. Quick story, saw a couple yesterday. Young couple, 40 years of age to 45, super combined 300,000. House was worth $1 million. They owed 550. The female client is a hairdresser. She was listening to all these people about, hey, you know, everyone's conquering the world. We've mentioned before that 2.2 million Australians own investment properties. We've seen property prices gone up in this country. Interest rates were an all-time high. You would have to earn substantial money to get an investment property in this country now. And we spoke about an SMSF. Good income. They're on about 280 combined.
Yep.
Good solid. And when I spoke to them about the SMSF, they were somewhat very attracted to the concept, given the advantages, right? When would you consider, what are some of the things that people really need to consider when they're looking at an SMSF? What are some things that people aren't seeing that they should look at when, you know, potentially looking at investment properties? To set up an SMSF, mate, roughly what are you looking at? And this is normal residential stuff. Yeah,
normal resi within a super fund. It's expensive to establish, right? So you have to set up your actual self-managed super fund, the entity in itself, and that can be a few $1,000s. If you want to then get lending, you then have to set up another entity, and that's called a custodian trust or a bear trust, which has to have its own trustee as well. That has to be a corporate trustee, and that's, again, got a cost associated to it. You then have to go through a financial planner and get a statement of advice, or at very least an investment strategy document from a accredited financial planner. All of that can cost up to 10 grand. There's annual reviews that has to happen on the super fund outside of just tax. So you obviously have to lodge your tax for your super fund. And then there's annual audits that happen as well. And that's a cost. So you have to enter it with eyes open, knowing that it's going to cost you a bit to establish. But then the benefits of it is the vast majority of clients in that age bracket, you're talking 40, 45, have a decent combined superannuation balance. So one of the difficult things in buying property in Australia is the increasing value of those homes. So you have to come up with a bigger deposit. Doing that outside of super can be difficult for some people. And some people look at their superannuation balances and go, well, look, we've got a big investment over here. Maybe we can sell that down and use that to purchase a property.
And the thing is, where I was going as well with that is that from a bank's perspective, if I was looking at buying, if this client were looking at buying, these clients, I should say, were looking at buying an investment property. Now, you're not going to get anything for under at least 800 to 900 and maybe a 15K radius of Brisbane, right? Well, they probably typically won't be able to borrow any money as an investment if it was just in their own name, right? So do you think we'll start to see people buying things in their own names diminish, and maybe the SMSF start to increase?
Possibly. It's really individualized around each person's situation. And it does come down to your living expenses outside of your superannuation fund, because the nuts and bolts of borrowing inside a super fund is exactly the same as borrowing outside of a super fund, right? It comes down to three things. What's the purpose? So what are you doing and why are you doing it? What's the security provided? So how much is the house and how much is the debt you need? How much of the deposit you have, and then the last thing is the serviceability assessment. So those three things that we look at inside of super are exactly the same as what we look outside of super. So it really comes down to how are you set up and structured as an individual, because the servicing piece inside super can be quite difficult.
But if it services within the super, the liabilities that the clients have in their own personal name aren't factored in.
As long as the superannuation can
Look
manage
after
the debt itself. Yeah, that's right.
So if you've got a 400 to 350 plus
Deposit.
in terms of
In
your
super.
combined super, with incomes of maybe 250 plus, would you encourage people to talk to us about possibly looking down that avenue?
Yeah, definitely.
Yeah.
Definitely. It's always worth a look.
Yeah, no, and we're starting to see it a lot, right? We saw the shift maybe 2 years ago. So that's probably where I was going with it. I personally can see more people looking at that option. Now, after retirement age, just a big factor, this is what everyone kind of loves, no capital gains once you decide to sell it at the moment, until the ATOs start to come clamping down on it. Typically, top three things that you would say to people, and we're close to wrapping up. What would you say to people? What are the three things that you would say, the top tips, if someone was looking at buying property within their SMSF?
Yeah, it's essentially always the same, whether it's a resi property in your personal name, as you own an OC, or as an investment, as super, as commercial. It's always have an understanding of your goals and where you want to go and what you want to achieve. Because look, I've had clients in the past where buying a property inside their super was just not recommended. They already owned 4 or 5 properties outside of super. And so they were going to be overweight on Australian real estate when you look at their overall position. Then I've had people that had their own occupied only and then a reasonably sized super balance. So buying a property within your super makes sense. It makes sense. It's a good option. So make sure you understand what you're trying to achieve and why you're trying to achieve it. And then take the advice of the financial professionals around you, because they will, or at least they should be giving you the best advice for your personal situation.
If you purchase a property in the SMSF, can't have family, it needs to be completely arm's length.
Yeah, that's right. So there's a lot of rules and regulations around purchasing within your SMSF, and that's been established by the government to strengthen the superannuation fund that you hold. So basically, super was bought in around the 90s by the Keating or Hawke government, because they could see that we had an aging population, and that aging population, once they hit retirement age, was going to put pressure on the government's coffers because of the old age pension. So they went, okay, well, let's get in front of this. Let's set up superannuation and let's have people become self-funded retirees rather than government-funded retirees. So they did all of that. And then when self-managed super funds came about and borrowing inside a self-managed super fund, they wanted to make sure that those individuals' overall financial position was not going to be significantly impacted should something go wrong with the debt inside their super. So it's really siloed off as its own entity. There's a lot of rules and regulations. You can't have family members in that property. You can't move into that property.
Can't construct.
You can't construct, right? So you can do minor improvements, like if the house desperately needs a lick of paint, if
bathroom,
it needs,
kitchen.
things like that. So you can maintain a property, obviously. All of the money to maintain that property has to come from your superannuation cash, so it can't come from your own pockets. And the government's done all of this to ensure that the superannuation and your retirement funds aren't negatively impacted, so when you do get to retirement, you don't have to go onto the government pension.
You can do an SMSF with multiple people?
Yep. Yeah, so there's a few different ways to create the super fund, and this is where a financial planner comes in because they have to give you the advice and they will help you with the structure in order to do it. So within a self-managed super fund, you can have up to 6 members, so that's 6 individuals. So and doesn't necessarily have to be a husband or wife or a married couple to do so. It can be a conglomerate of people, but there has to be a reason as to why it's going to benefit all members.
Which typically you might find in commercial people purchasing in the SMSF, right?
Yeah, that's right, especially if they're trying to purchase a large commercial premise for a business that they run, or an office space that has a few different offices within it that they can all run their own businesses out of. Yeah, so commercial for sure.
Mate, and I know the funny thing is that we have had a few brokers refer clients that of theirs, right, from SMSF. So it's quite a unique product that a lot of brokers can really mess up.
Yeah.
If they don't know what they're doing. But it can take a little bit of time. But I love it. I think it's a great avenue personally. But you do have to have a decent sized deposit.
Yeah, that's right. You got to go in with your eyes open around it.
Yeah.
That it is a lot more expensive. Fees are higher. Interest rates are higher. The bank you end up may not be with a bank you've heard of before. But there are definitely upside advantages of purchasing an investment property as well.
Well, look, we deal with a few financial planners that specialise in this area. We as a business, you in particular, are probably one of the best in the business, I would have to say. So for anyone that wants to get in touch, touch base with yourself, touch base with us. But mate, thank you for coming in. I have to admit, you're probably one of the most methodical brokers that I have come across. And mate, we're fortunate enough to have you. So thanks, mate. Appreciate it.
Yep, no worries. Thanks for having me, mate.
Cheers, bud.
Thank you.